First, looking at production costs, these are USDA estimates from June for 24, 25, and 26 production costs. We've seen operating costs come down from their peaks to some extent through 24 and into 25. But looking out to 2026, the USDA and us too are projecting slightly higher operating costs given the current outlook for a variety of those inputs across all corn, soybeans, and to a lesser extent wheat, but still wheat too. Over on the nitrogen side, like Matt mentioned, we've seen nitrogen prices stay higher than I might have otherwise expected earlier this year. The dashed line there at the bottom is sort of what I estimate to be a production cost level delivered to an average Midwest point. And so that kind of serves as a minimum floor, if you will, for what I would think nitrogen prices are given inputs to manufacturing nitrogen fertilizers. And so the closer, we could get to that line, the better off we would be. Now, given some of the geopolitical factors going on, Russia, China, and other things going on now, we've seen some supply issues show up in nitrogen markets, and that's what's holding those nitrogen prices higher than what that bottom line would indicate in a overall well-supplied market. Looking out to the end of this year and into early next year, I think we continue to see nitrogen prices likely remain elevated at similar levels to where they are now for a variety of those supply reasons, as well as some uncertainty in natural gas markets as well. When I look at natural gas in Europe, we have storage going into the winter that's just slightly below normal levels. And so I do worry a little bit that we could see some upward pressure on nitrogen prices in the middle of winter or as we move into later spring or early spring if we see winter turn out colder than might otherwise be expected, which would push up the demand for natural gas for heating, maybe both here and in Europe, where some of those major production points are. So this is what the outlook is for anhydrous. If we look at urea at the moment, a similar story going on there, but probably a little bit more supply pressure there, which has held those prices even higher relative to those benchmarks that we might see on the anhydrous side. Looking at phosphate and potash, we did see phosphate prices come down a little bit from their peak in mid 2022, but those prices do remain elevated and by a lot of metrics, extremely expensive relative to grain prices, given where current price outlooks are for both this year and into the near future. One early place of optimism I had was on the potash side. I thought we might be able to see steady potash prices, in the mid 400s or low 500 range early on. However, we've seen global values continue to rise, flatten off recently, but rise above where those U.S. prices are, which is going to serve to push those prices up a little bit as we move through summer into thinking about fall and application for the 26 season. Looking at farm diesel and propane for a moment, diesel prices are currently expected to remain largely stable over the next 6 to 12 months. And I think another factor contributing to that is kind of the crude oil outlook, where we expect to see a well-supplied crude market over the next 12 months. And so I think all of that works together to keep those diesel prices in check and maybe offer some slight relief to that total operating cost, an operating cost total for the 26 crop year. Given some of the potential upward price concerns I have on the natural gas market, we could see LP prices rise into this fall and rise even more late in the winter if we do see weather turn out a bit colder than what we might expect or what might be normal, both in the US, Canada, and Europe to some extent. When we look at total production costs, so here we've taken the blue bar I showed at the beginning and added on the other machinery, land, and other overhead that the USDA estimates for the rest of the total cost of production. When we look at for 24 and 25, Those white X's there are what the gross market returns are given USDA's current estimates. And so for 25, we do, given current prices, expect to see a fair amount of pressure on the gross margin there. I would highlight that, this does exclude any potential crop insurance net indemnities, as well as government program payments that may or may not be made, depending on where those season average prices come out. So while there is pressure in the short run, the total return may be slightly above that white X when the year is all said and done. Again, looking out to 2026, we do continue to see machinery and land values that are reasonably expensive, and that does serve to hold that total cost of production maybe a little bit higher for 26 than we saw in 2025. We're going to talk about equipment for just a few minutes. I think we think new equipment prices are likely to remain sticky, and probably hold it at somewhat higher levels than we might otherwise like to see. Here I have four producer price indices from the BLS. The top one here that you can see stick out over here towards the right side, it's in that light green color of sort, or the darker green color of sorts, is the PPI for repair services. So we continue to see the service component of repairs continue to creep higher. That probably likely moves up as overall labor costs continue to rise to some extent. The medium green bar or line there is for repair or parts, the individual repair parts. We've seen some slight weakness on that recently on total. Now, I would highlight that this is, a very aggregate measure, and so the cost for any individual part may very well be higher than it has been in the past. The purple and orange line there are the overall price index for farm machinery and equipment, two different measures of that. And we do continue to see strength and probably notably a lack of weakness in that price index. But I think it largely comes down to, the inputs to machinery manufacturing continue to be a little bit more expensive as well, whether that's both metals or labor. And that probably serves to keep those prices higher than we might otherwise like, seeing the low returns we have now. Looking at what farm equipment companies have done, I think they've tried to right size supply given the expected demand for machinery as well. And I think from what I can tell, they've largely been successful in doing that. And that I think will also serve to limit the decline in those new machinery prices going forward. That's not to say there may not be some incentives offered that you may be able to take advantage of, but be on the lookout for those and be cautious of those new machinery prices. When I look at the used machinery market here, I've taken the broad average used machinery auction values from Machine Repeat data and kind of lined up here two price cycles, looking backwards in time. So from the 2010 to 2019 period is the blue line there, and I've overlaid on top of that in green from the 2020 to 2025. We saw prices run up there through 2024 and have recently come down in 2025. And to offer some idea of what this may look like going forward. Now, there's no guarantee that the future is going to match the past exactly, but if the price dynamics of the last cycle continue from this cycle going forward, we do expect used machinery values to decline to a lesser extent into 2026, and then to be more or less flat over the next few years beyond that. And that assumes that farm income does continue to be somewhat weak. We need to continue to see low-ish commodity prices, and if those margins don't necessarily remain negative, but they do remain somewhat tight. When we look at equipment sales year to date, new sales for tractors or combines are down anywhere from 26 to 43%, while at the same time, inventory to sales ratios have recovered to levels that we saw pre-COVID when we were short on machinery in some places and in some types of machinery. And so those, I think, do indicate some opportunity for producers out there that may want to be may want to look to upgrade or swap machinery or looking for opportunities there. That doesn't mean that opportunity may not still come at a cost. We do continue to see financing costs remain elevated relative to where they were just a few years ago. And so even those relatively cheaper used machines may still have a higher finance cost associated with those. For more information on the machinery outlook, we have a quarter three 2025 outlook related to farm machinery that's available on our website, terrainag.com.